Hi everyone, good afternoon from India, and I'm Devyani, and alongside my colleagues Varun and Birju, we are delighted to have this opportunity to tell you a little bit more about our work in secured lending in the context of financial inclusion. Hey guys, Varun, you want to go?
Yeah, I am Varun. I am co-founder of Savdan. Glad to be here.
I am Birju. I am founder of Cretin. Glad to be here.
Super. So, without further ado, we just start with some quick context before we jump in. There's a bit of a misnomer that lower middle income households do not hold assets beyond perhaps some property or gold, but they do. Livestock, commercial vehicles, and savings in financial instruments such as life insurance and postal savings are commonly held. So, for those in the missing middle or households with needs beyond that which traditional microfinance can service, yet who are overlooked by the formal banks and NBFCs, assets can be a huge unlock. So, we'll talk primarily about India, but this opportunity exists to service the missing middle across emerging markets. We want to tell you a little bit about the potential of some of these commonly held assets. So, in dairy, for example, about 55 million cattle are traded each year. That's over $30 billion potential, liquidity that can be unlocked. Yet dairy forms a very small proportion, less than 1% of priority sector lending today. In terms of commercial vehicles, about 50 million small, medium commercial vehicles are, held in India. Less than 10% are traded, and so the liquidity that's the book that exists is primarily against purchase of these vehicles, but the opportunity is over 10 times that to really enable the asset to offer liquidity to these households. And in terms of savings, over 150 million people save in life insurance and postal savings. They hold a whopping 80 lakh crore, that's about $900 billion in these instruments. So enabling lending or leverage against even a fraction of that figure can unlock huge liquidity. So this is a large opportunity to create new entry or graduation points to formal affordable credit, building pathways to sort of stronger credit profiles and a virtuous cycle of future affordable credit. So with that, I just want to jump right in, starting with Varun and Sarvadan.
Sure. Thanks, Devyani. Hello, everyone. So, I'll quickly talk about Savdan and also talk about the problems that the missing middle are kind of facing in the emerging markets. So, at Savdan, we are trying to actually build an operating system to give the right leverage to the used vehicles, primarily commercial vehicles and passenger vehicles in the country. Now, first we understand that what is the profile of these users, who are these users, and what do they do, and what are their problems. So these are typically 30 to 45 years old. They have some kind of small business, or they might be kind of actually have in a profession where he is driving vehicle which is owned by somebody else, and he has an aspiration to maybe grow himself and maybe buy a vehicle of his own in the future. Second, largely these are the sole breadwinners in the family. They have irregular incomes because the kind of assignments they get is ad hoc. They might get it maybe a 7 days in a week, or might get only 2 days in a week. Most of these people and most of these households own at least one vehicle in their family, and largely those vehicles are tractors or maybe a small commercial vehicle. Then there is a part of agricultural income also associated with these family. When we talk about the credit profile of these borrowers or these customers, these thin file customers, they might have taken a small Kisan credit card, which is very popular in this population in India, or maybe a small gold loan which they might have mortgaged to borrow some cash. And also when we talk about the problems of these profile of customers, so they on and off every now and then they come across a situation where they are looking for cash. They need cash to maybe promote their farm, or to grow their crops, or maybe some seasonality trends, some kids education, some marriage in the family. Now these profile of customers have do not have access to a lot of structured credit options in the market. Definitely, a lot of NBFCs now have a lot of branch network in tier two, tier three markets, but not every lender, not single lenders is able to serve all kind of customers. There are different risk appetite for each lender. So with that, they are like in short, they have very limited access to the kind of credit they want, and also they don't have options in credit. They have very limited number of options. Secondly, there is nobody who is able to guide them that okay, what is the right option for you in terms of your needs. Like I'm a farmer, I need 3 lakh rupees for a marriage at my home. Now, whenever I go to maybe a local agent in the market or maybe to a lender, everybody is trying to force fit the product they own. Say, for example, I am a banker, I have a responsibility to grow my unsecured lending book. So I'll push my unsecured lending book. Or if I have a option to grow my gold loan book, then I'll force fit the gold loan related product to the customer. But there is no platform that can actually look at the entire spectrum of assets that the customer holds and guide them appropriately. So at Savlan, this is what we're trying to do. Can we go to the next slide, please? At Savlan, this is what we are trying to do. We are trying to disrupt the already existing value chain in the market. So if you see the diagram in the middle, there is a customer on the top. He is actually in touch with point of sale. Now point of sale could be maybe if he's able to want to buy a vehicle, then he's going to a dealer in the market, or if he's looking for loan, then he might go to an agent in the market or might go to the bank directly. Then there are banks and NBFCs who are directly lending. A large part of these structured or secured finance, and largely I talk about used vehicle, that is the first problem that we are trying to solve, is that this largely happens through a point of sale. So Sarvdan sits between the point of sale, which is a dealer or a agent in the market, and also on the other side we have banks and NBFCs. Now at Sarvdan, our primary user are these point of sale, these dealers, DSAs, who have demand coming in, who have a customer who walks into their maybe store or shop or whatever branch, and they look for finance options. Then these dealers on a single platform like Sardan get right can do a quick pre-profiling of the customer. Now say any customer who walks in and say ki, I want to avail 3 lakh rupees loan, and this is the kind of vehicle I have. Or even if he doesn't tell that what kind of vehicle I have, if I do a pre-profiling on Sarvdan system is equipped enough that he will be able to tell that sir, you own a asset. Can you tell me more information about that asset? What is that asset? And that's how the pre-profiling of the customer is done, and the right loan recommendation is offered to the customer. Now in this way, we are now able to actually empanel around 27 plus lenders with us, constituting bank and NBFCs. Some of them are listed here. And in terms of loan product, this loan product is a high AOV product. Its ranges somewhere around 6 lakh rupees on an average tenure of around 3 to 4 years, with IRR ranging anywhere between 18 to 21%. And also there is an upside to this, that if customer is looking for cash and if he has an asset like any commercial vehicle or maybe a personal vehicle, if he mortgages that vehicle, he can get up to 200% of the value of the vehicle as cash for his personal use. So that actually improves his spending. Like he can improve his the total LTV. And also this is way cheaper than unsecured lending in the market, because it operates at 18 to 21% as compared to somewhere around 24 to 30% on unsecured side. As a fintech platform, we keep innovating, we keep involving new technologies, and AI is coming deeper into whatever we do. So what the customers are, how are they, what are their assets, and everything around the customers we keep learning, training our ML engine so that we can give better recommendations. And also because secured lending is operation intensive, so we definitely are trying to deploy a lot of AI agents, and also slowly moving trying to move towards agentic AI, through which we can actually remove a lot of opex that is involved in the entire loan processing. So with that, I hand it over to Birju to talk more about how Credin is solving this.
Hi, I'm Birju. I'm founder of Credin. So at Credin, we provide loans to dairy farmer to purchase new cattle. So it is backed by cattle as an asset, wherein we help them improve the cash flow. So the objective is there are small and marginal farmers having less than 2 hectares of land holdings, and generally for them dairy becomes the primary business because agri is cyclical, and with the 2 hectares of land holding, they cannot earn substantial agri income. So this is the segment which is sweet spot for us, and they are regularly pouring milk into the nearest milk cooperative. So we can easily check the cash flow of the dairy farmer. But the problem here is we have around uh, 80 million dairy farmers in India, but the priority sector penetration is less than 1%, as highlighted in the earlier slide, because no one has built the vertical play for this particular ecosystem. So from the ground, we saw huge opportunity that this is the segment for whom we can actually build the entire stack. So it's been 3 years since we are operating, and we have disbursed around $10 million to more than 8,000 dairy farmers. Coming to the profile of the customers, every ecosystem has basically a grid wherein the top 10% of the dairy farmers running it as an MSME, because India is different from the world, though India is the largest milk producing country, but it is mainly contributed by a lot of small and marginal farmers. So only top 10% are running it as an MSME, and then there are top 15 to 20% bottom of the segment who are having 1 or 2 cattle mainly for their own consumption. Okay, so this bottom of the segment getting the MF microfinance loans, and the who are running it as an MSME get the formal access to credit. But there is a segment in the middle having 5 to 15 cattle earning around 20k to 60k, around 2.5 lakh to 6 lakh a month. So they don't get the formal access to credit because they have aspiration to take it further. They are small and marginal farmers, and the good part is it is mainly managed and executed by the women. But in 35% of the cases, 35 out of 100 cases, wherein there are women members of the dairy cooperatives, and they have the direct bank account in their name. So we have around 35% women borrower on our platform, but otherwise also it is executed by women only. So here we are also empowering the women. Credit context here is whenever they need money to induct cattle, either they have to block the cash flow for 2.5 months, because average in India 9 out of 10 new cattle inducted are hybrid HF cows. Okay, so it costs around 70 to 80,000 rupees per animal. So they have to block 2.5 months of cash flow, or uh, in cooperative structure, wherein out of 80 million, around 15 million are covered under formal cooperative model. They get an annual bonus based on the annual volume. So once they receive the annual bonus, then they basically purchase new cattle annually, but it is not available on the tap. Okay, so here we come into picture wherein we provide them loans to purchase cattle. Please next slide, wherein I'll take you through the business model and the product as well. So we provide loan up to 3 lakh rupees, wherein it is 60,000 rupees per cattle. It is insured, cattle is insured, newly inducted cattle is insured. So the risk is covered for both dairy farmer and for us. They can purchase up to 5 cattle, 5 cows or a buffalo, and it is purely a collateral free. We don't need any collateral. Okay, it is just backed by cattle as an asset. So from existing asset, they are generating a cash flow, and we are based on that cash flow, we are providing them a loan to purchase new cattle, increase their income within 48 hours. So here the rate of interest varies between 18% to 24%. So on an average on our platform, we fund for every 2 cattle, and with the help of, by inducting 2 cattle, they can increase their monthly cash flow by 15,000 rupees. while their monthly EMI would be around 6,500 rupees. So there'll be a 8,500 rupees surplus. So they are generating a surplus cash flow of 8,500 rupees on a monthly basis. So we are helping them building resilience. We are helping them increasing cash flow, and also we are also helping reducing the urban migration, because at the village level we are helping them providing credit to scale their business. Or we, as a credit, we act as an LSP lending service provider. It is an Amazon kind of a model, wherein anything you are purchasing from the Amazon, you are actually purchasing it from the seller, but you don't know who the seller is, because everything is managed by the Amazon. So on this same way, on our platform, NBFC and banks act as a seller. We manage everything on behalf of them. So it's a zero OPEX model for banks and NBFC. And it's a win-win proposition, because banks and NBFC generally operate with a brick and mortar model. So with the average ticket size of around 1.5 lakh rupees and funding to small and marginal farmers for 2 cattle, it is not viable for them with such a OPEX heavy model. So there we come into picture, and we manage everything on behalf of them. Uh, on underwriting, it's purely backed by the cattle income cash flow, because it is visible. And in a cooperative model, it is directly credited into their bank account. So through account aggregator, we can fetch their cash flow. And apart from that, if the bank is not part of the account aggregator framework, then we can ask for the milk statement. And our thesis is on product graduation. But now we believe that it is the segment wherein the cash flow is visible. So they need a product which is very specific to their ecosystem. So now they are getting a product through credit wherein they can purchase cattle and they can double their cash flow. On AI piece, we have around 32,000 dairy farmers primary data. So we have their entire demographic details and cattle images available. With the help of LLM and the secondary global benchmark, now we are working on a proposition wherein through image we'll be also underwriting their future.
Biju, you're cutting out. Okay, we've lost him.
Sorry, I'm
Biju,
back.
you just cut out. Sorry, go ahead.
And apart from that, we are also working on the building the agents, wherein we can further optimize this model by automating all the underwriting discussions with the customers, which is a video discussions, and that will be managed by agents, and all the soft repayments alerts and pre-EMI reminders will be managed by agents. So these are the couple of propositions that we are working on, wherein we'll be solving through AI. So that's all from my side. Over to you, Divya.
Thanks, Biju. So last one, and I apologize, my camera has stopped working, so you'll hear a voice with no image, but bear with me. So at Miracle, we enable savings against traditional financial instruments such as life insurance and postal or small savings schemes. Our objective is to improve financial management for thrifty households by offering leverage as an option to help those seeking liquidity to make more efficient choices, right, and prevent premature liquidation, so liquidation at a loss, or the use of expensive informal credit to meet that need, which is common, and we'll come more to that. But who are our customers? They're typically people between the ages of 25 and 60 who are either self-employed or salaried, but earning anywhere from 3 lakh to 15 lakh per household per annum. So that's about just under $4,000 per year per household to as high as $17,000 per year per household, right? They're largely urban, with about 60% coming from large cities, metros, tier 1 cities. So think of blue collar, gray collar workers, service sector folks in the cities, people working in informal businesses, MSMEs, many proprietors, business owners, and about 30% come from towns from tier 2 to tier 5, and only about 10% of our base today is rural. In terms of gender, circa a third of these savings are held by women, and our goal is for the portfolio to reflect this split. We're not there yet. Women only make up about 20% of our portfolio today, but there's scope to really go deeper into rural areas and with women as a base by accessing channels that offer more assistance, and that's where we'd like to head to over time. But just going back to the customer profile, what is their current credit context? Many of these people have either a thin file or no file on a credit bureau, right? So many of them don't have the option of accessing formal credit. Some do have a bureau profile, but are only eligible for personal loans or credit cards at say 20-30% per annum, right? Basis their income profile. So depending on who their employer is, depending on what their score is, etc. on bureau, they're typically only getting higher interest options. And ironically, years of contributing to savings plans doesn't help build your credit profile. So those seeking liquidity often either have to liquidate their assets at a loss or seek expensive credit sometimes in the formal market, but often in the informal market, right? And this is actually the insight that got us started working on this to begin with, which was that we had customers who had been investing in mutual funds, had already had a history of saving in other instruments like life insurance and postal savings, etc. But when it came to accessing credit, was struggling to get any of it, and therefore were liquidating or making sort of inefficient decisions to access that liquidity. So when I say that penalty for liquidation is high, maybe so what are their options, right? If they can't access formal credit, or if they're only getting a more expensive option, essentially they either take the expensive, often informal option, or they liquidate that asset at a loss, right? And in the case of life insurance, that's a significant loss. So, for example, the penalty is very high. So these are very long-term contracts, anywhere from 10 years to whole life. They're optimized for protection in the case of an unfortunate event, and to build a large savings corpus by the end of that term, right, or that maturity period. So breaking the contract part way is an asset liability mismatch issue for the insurer, and therefore incurs large penalties for the customer, anywhere from 30 to 70% of the savings contributed, and the interest accrued to date is forfeited depending on how far along in the contract you are, right? So in such instances, leveraging the policy makes a lot of financial sense for customers. The same is true for other types of assets. So how does this work? Essentially, we're a platform, right? We service lenders on the one side and customers on the other. For lenders, we act as a loan service provider by acquiring customers for them and offering a collateral management system that helps them verify the asset. So, Divyani is coming in with this savings instrument. Is it real, or is that, forged document? What is the value of this asset? What's the underlying asset, and how do I underwrite this asset? So that's the first piece of it. It enables them to set rules, bases their risk appetite, and generate offers back to these customers, and then manage that collateral value over the loan book value, right, over the life cycle of the loan, and enable closure at the end of that period, or recovery, right, as required against the asset. We work with both banks and NBFCs. Some of our early partners are listed here. And on the customer side, we essentially enable them to start the journey from where they seek credit or are managing their savings. And this includes loan marketplaces, brokers, financial advisors, employers, points of purchase. For example, when you're starting to look at purchasing a second-hand vehicle or commercial vehicle, the journey could start there. Distribution platform. So wherever they're looking to manage their portfolio or looking to seek liquidity, business correspondence, for example, is where we aim to be present on the customer side. So how does the product work? Essentially, this is a product that can be structured to suit the needs of the customer. Our lenders offer different terms. So there's term loans, standard term loans as overdraft options, and banks can only offer overdrafts against these assets. And there's also bullet repayment structures if that's the preference of the customer, and if the underlying asset or instrument has the need for that because of a lock-in, for example, there, right? So these are offered at 10.2% per annum up to about 16% per annum, depending on the lender and the loan structure. In terms of underwriting, it's essentially the lender's underwriting the instrument or the value of the underlying asset, right? So it varies basis what the underlying asset is. So for most of these instruments, savings instruments, the underlying asset is government securities, and so lenders are willing to offer up to 90% loan to value of the savings. In the case where the underlying security is market linked, so whether it's debt or equity, that loan to value ratio comes down, and it can be anywhere between 50 to 75%. But that said, some lenders are willing to offer many times the value of the instrument in the case that, so it could be 2 to 4 times, in the case that they're also underwriting the customer's business. So where it's an MSME loan, and the business can say, manage to repay basis its cash flow a higher value loan. They take pledge of this asset, which is liquid and reliable, but also less liquid assets, say perhaps machinery and equipment, and are willing to offer larger ticket loans. So that's another way that's interesting for customers to leverage. And it's a good way to build a credit profile and access, affordable credit to safeguard future access without disrupting that ongoing plan, right? So whether it's a term deposit, whether it's a life insurance plan with a 20-year maturity, etc., you can get the liquidity you need when you need it without having to disrupt the discipline that you've built over time. What do customers use these loans for? It's typically about a third are for domestic use, 20% for business, medical and home upgrades are the other most common categories, and then some education, marriage, debt consolidation is an emerging category that we're seeing. So that's typically it. I'd be remiss if I didn't touch on AI. So as my colleagues have mentioned, we also use AI models to help read documents and structure and process the data, and we're working on improving the efficiency of pre-sales to sort of servicing communications via voice and chat. So yes, I want to stop there and quickly move to closing remarks because I know we're running out of time. Guys, do you want to jump in with me?
Sure.
Yeah, definitely.
So, so I'll just cover on the data layer quickly. So over the last decade or so, India has progressed a lot in terms of collecting and creating central repositories, whether in terms of DPI or whether it is account aggregators, UPI, ULIs, ONDC. So a lot of things have come up in the country, which has evolved specifically to lending, which has definitely eased down a lot of efforts, and that's kind of resulted in a very big movement in terms of how unsecured lending kind of boomed in the country. But when we compare the same thing with secured lending, I think there is still some ground to be covered, and whether it is related to vehicle-related loan data at a central repository, closing vehicle-related loan data through a central repository, milk stack, like what is the collection receipts, land records, so that it can be easily available to us, and also to the lender, so that it can help in terms of the lending quite easily and maybe error free. So, and also like because account aggregators have banks and banks coming in, like other things like RRBs or the cooperative banks or the post office and other things should be available on account aggregator network, so that lending around these secured products can be done easily. Yeah, Birji, you want to cover on the investment side?
Yeah, even I want to have one point here on DPI 2.0. So we are at Credit, we are working with IFC, International Finance Corporation. And under India Advisory Project, we are the first fintech to go live on open network for agriculture, wherein the WhatsApp journey is built for the farmers and dairy farmers, wherein they can all the services available on the WhatsApp, and we have built a journey wherein on WhatsApp only they'll get the in principle approval for the loans. But at the same time, there is a lot needs to be done on the cattle data repository and dairy stacks as well. But I'm sure that in next 2 to 3 years, landscape would be totally different. And coming back to funding, I think there is what we have seen is there is a lot of void between pre-seed to a series A, because these are the problem statement wherein the founders are solving from 0 to 1, and it is a lot of execution heavy to start with, because no one has did the early no one has basically built something here in earlier in three of us cases as well. So but at the same time, these are businesses which can be scalable as well, but the perceived risk initially is very high. So basically, we need a lot of participants here on the equity side that can provide us the continuous capital. And at the same time, there is huge scope for opening the blended finance. It could be a convertible debt. There are instruments already available like convertible notes and risk guarantees. One of the good proposition that we got is we are now collaborating with Rabu Foundation, wherein they are providing us the risk guarantee for a around $1.5 million program to start with. So this is again a good initiative, but then we need again a lot more participants to support this in our journey.
Yeah, thanks, Birju. I'll just add to that in terms of the funding side. I think, essentially we're trying to bring down the cost to the customer, right? And the average fintech loan in India today is still about 25%, right? That's the average cost to the customer. And the goal for all of us is to, offer loans that each of us are willing to take ourselves, right? And none of us are willingly choosing loans at 25%. So whatever we do in terms of technology and bringing down the cost of acquisition, the operating cost, etc., until we can bring down the cost of capital, that that doesn't move, right? The price point to the customer doesn't move significantly. And so it's really critical to see this sort of more holistically, and it's about funding the fintechs from building out the technology platform, making the market, making the the infrastructure from a data perspective, etc., work, but also to enable larger lenders to enter the space and reduce that risk perception, right? So that the cost of funds comes down and the eventual cost to the end customer comes down significantly. And so yeah, I just want to mention that. But thank you all. Thanks, Birju and Varun. I know we've run over time, but this was great to have this discussion. Thank you.
Thanks, Devyani.
Thanks everyone. Thanks Devyani. Thanks Birju. Thank you everyone.
Thank you.